Hello, everybody. I'm your boss, Joe Boss. Man, is it early for me this morning. I usually don't stream this early, but you know what? It's CPI, and I thought I'd go ahead and pop on the stream for today's CPI. It's going to be a big mover, whether it comes to the upside or to the downside. And I wanted to go over a couple of resources that I've found and just give a good refresher going into this CPI. So here on the right hand side, I have all my little resources here. I have 4 standard charts. We have the DXY here in the top left. We have the S&P E-mini futures. Then we have crude oil futures, and then Bitcoin right here. And you can actually see the dollar had a spike here. This is a 5-minute chart on all these, so we'll see any quick, fast, short-term moves going into the CPI event. Coming down here in about 27 minutes. All right, anything here? Wells Fargo says we forecast headline CPI rose by 0.04% for a second straight month, pushing the year-ago rate to 3.5%. And then I believe Bank of America set this, we expect core CPI inflation to go down. So core is expected to continue drifting lower. Headline, it depends on who you talk to. Really depends on who you talk to. This is just a tweet. We have a bunch of X posts here that we're going to be going through because people have been posting stuff on X because it's a lot faster to get stuff through X than through your, institution's platform. So a lot of people have been posting stuff on X to get people in the know really, really quick. This is new tenant rent, and apparently there's a relationship between new tenant rent and the leading as a leading component for CPI rents. And CPI rents are a component of the shelter component, the services side of CPI. So seeing that go down leads us to estimate, hey, maybe the shelter is going to come down going into the future. And Fed fund futures, market pricing for Fed policy rate moves. Yeah. U.S. investors sentiment via JP Morgan AM index. Conviction in U.S. Treasury rally fades JP Morgan Treasury investor sentiment. All clients net long. It's now flat at 0 there. Wall Street Jesus, what a guy. The guy's the resource apocalypse. You guys think I post a lot of outlooks. You guys think I post a lot of research. You should check out Wall Street Jesus then. In terms of the market's reaction function, this is from Goldman Sachs. So this is Goldman Sachs expectations for how the S&P, which is this chart right here, the S&P mini is what we'll be looking at for this sort of reaction, depending on how core month-over-month CPI moves. So if we get the move that we just saw here out of Bank of America, which is this area right here, seems like Goldman Sachs is also in this estimate zone as well, we could see a 0.5 to 1% move higher on the S&P, depending on how that core moves. Okay, let's check this out. This is a big old fat post. So this is someone's crunch of the numbers. US, and by the way, this guy, Nicholas, not financial advice, right? US inflation data for March predictions. So let's see here. World Trade Securities predicts a 0.3% increase in consumer prices month over month. Rising gas prices are expected to be a key driver of inflation here. Yeah, oil, all energy prices have been just absolutely rocketing. Food prices also likely to edge up slightly. Core inflation, which excludes food and energy, is estimated at 0.3%, probably going to come in a little bit lower than that because it excludes food and energy. This is a bit lower than recent months, but still in line with the latter half of 2023. Rent is a major factor in inflation, and we expect some moderation in its upward trend, which is a good nominal expectation. We predict a 0.3, well, at 3.8 to 3.7 annual increase. Used car prices are expected to continue dropping, while new car prices might see a slight decrease. I've seen a lot of people talk about car prices impacting the expectations for CPI to come in lower, specifically. And that wouldn't be the first time that people have been jumping up and down saying, hey, car prices are coming, the car prices are coming. We've had a CPI, I think sometime last year, where used car prices jumped astronomically, and it was so easily telegraphed because there's like two used car price indices that moved super significantly, and everyone had their eye on it. And it, when you only have one component move the entire index, while people still react off the headline, there's a bit more decay in that move, because most of this move just came from one component. So once we get to the next report, so long everything essentially stays the same, once we get over this hump of that one spike in that one component, we should start to see nominal numbers again. So there's kind of a time decay on those particular types of releases, kind of like what I'm expecting to happen sort of with the manufacturing PMIs, but we'll get into that maybe into a later stream or later today. Public transportation price hikes are likely to slow. So that's going to be a net contribution to CPI. Communication costs rise modestly. Apparel price might dip again. And medical care costs, of course, those are sticky. There's very little elasticity in the prices of medicine. And here we go. So here's the consensus range for CPI, headline, and core. So 0.3% to 0.3% and 0.2 to 0.5 for the headline. So this headline has a much wider range than the core at the moment. On to the next set of forecasts. So if you're wondering where these consensus nominal expectations for CPI come from, this is where they come from. All these institutions go ahead and discuss, and they share their expectations for CPI. So here's the headline and their core expectations. This first number is the month over month. The second number is the year over year value. So everyone's pretty much in line on consensus for what the year over year number should look like. But there's a bit more variability in what the headline value is going to be. You can see that there's like Citigroup's expecting 3.8 here. That's close to 4. Barclays is 3. Who's the lowest on this group? Looks like Bank of America, right? Headline CPI 2.5 for headline and 2.4 for the core. So Bank of America is in the bottom half, expecting inflation to really cool here. Everyone else is pretty much in line with 0.3, maybe just sub 0.3, except for a couple like Citigroup and Barclays, JP Morgan. So the consensus looks like, hey, we'll probably get this. The median forecast is 2.9. So that's what Goldman Sachs put down here. 2.9, that's the median. And then for the core, 2.7. So if we get this sort of number here on CPI, if we get note that when you look at your economic calendars on the release, you're only going to see this first decimal point. So if it comes out at 2, a lot of people are going to react off that 2. If it comes in at 3, yeah, things are going to probably behave moderately well. Not super crazy, but still risk on. But if it comes in at that 2, we could see like a 1% higher move here on the S&P, see the dollar plunge some more. Bitcoin will probably hold up. Same thing with crude. And then I can also put gold here. You can see gold is rising at the moment, going here into the hour for CPI. Okay, and then we got 2 more here. ING Economics on potential asymmetric responses to today's US inflation data for the US dollar. So from ING, we do, however, see asymmetric responses to CPI. A firm number has been expected and is consistent with the sticky inflation. Okay, so core CPI at 0.2 month over month, then we would see a dollar rally, really. On a 0.3 or even a 0.4 release. I don't know why they're saying 0.3 or 0.4 for the core, because that does not seem all too likely, given the expectations we saw over here. So that would be quite a big surprise to see 0.3, 0.4 CPI on the core measure, not the headline. And one more. This is a big old fat thread that just got posted like less than an hour ago from Bob Elliott. While we await the biggest US CPI print of our lives, let's turn to our neighbor up north. So this is talking about Canada and the relative economic growth of Canada to the United States and how it doesn't look all that great for Canada at the moment. So I'm going to go ahead and save this and read this for another time. If you want to get the link for this, that's going to be, I believe, in the economics channel. Yep, it's in the economics channel of the Plan the Profit Discord. And speaking of that, if you want, there's an open poll right now in the general chat of the Discord server. I'll actually go ahead and start a poll right now here in the YouTube chat. What are your expectations for US CPI month over month? And we'll start that poll. So what do you expect US CPI to do on the month over month numbers? Do you expect a nominal view? Essentially, we get these prints here at the median forecast. Do you think we get higher inflation than these numbers? Or do you think we see a deceleration in inflation? So a surprise lower. So nominal, higher, or lower. And we'll keep that poll going until like the couple of minutes before CPI comes out here, which is in about 14 minutes. And FYI, you might hear a guy also speak on this stream. I'm going to be pulling up the squawk from Financial Juice, and I'll have that playing here in the background. Let's go ahead and check out the news stream here from Trading Economics. US futures are edging higher. Oh, wow. Yeah, check that out on the S&P. We just got a 5-point move there in the last 15 minutes. So, stock futures in the US were flat. And things are looking pretty good here. The odds of monetary policy ease by the Fed in June currently stand at around 54%, and for July at nearly 73%. At the same time, the FOMC minutes due later in the day could offer further clues on when the Fed could implement its first rate cut. And then they're talking about some corporations. They're talking about Delta going up 5% pre-market and Nvidia going down, and how essentially the Magnificent Seven, the top 10 performing assets in the S&P 500, are pretty mixed. Looks like gold and Bitcoin aren't holding up too well, even as the dollar is falling. S&P giving us a little bit of a pullback there. All in all, things are going pretty standard here. So not much left to do but to wait. Let's pull up our financial juice here. There we go. And as soon as USI comes out, we should be seeing it print right here on the economic calendar. Oh, UBS enters a trading halt. Uh-oh. UBS faces increased capital requirements under Swiss bank reform. Yikes. Not good news for one of the largest banks in Switzerland. One of the largest banks, period. And again, we'll keep that poll going until like 1 or 2 minutes before CPI comes through. Let's see here. So far, we got 50-50 for nominal and lower. And guys, let me know if you caught that stream highlight clip I uploaded yesterday. It's kind of hilarious because when I uploaded that stream highlight clip saying, hey, there's risks of a rate hike potentially in the summer if inflation reaccelerates from here, and less than like 8 hours later, like almost on the same day, someone from the Fed came out and said, we may need to do one more hike. And it made it on Bloomberg. And then some other Fed official came out and said, well, I'm still hoping for 3 cuts. Three cuts is kind of what we're expecting. So there are these conflicting views coming out from the Fed. Quite a bit of uncertainty, even on the Federal Reserve side, as what to expect going into the summer here. And so far, it looks like the dollar is fallen. And the S&P keeps climbing. Bitcoin seems like it's holding up. And gold futures, they ain't moving a whole lot right now. Let's go ahead and turn on the Squawk chat. Yeah, Ridge, I actually would agree with you, my man. Next month probably could be lower. It really depends on how energy performs, because energy, especially something like oil, could continue its run up, especially if manufacturing continues to improve. The supply constraints for a lot of commodities are currently just butchering people's costs of manufacturing. The largest component for the manufacturing PMIs rising was the prices. They passed on a lot of the increases in prices to their customers and to warehouses from the wholesalers, so it's not looking so good on the manufacturing goods side of inflation going forward here. So maybe inflation is still decelerating, but it's still, I would expect, to be quite sticky on the good side going forward. A lot of people still expect deceleration on the good side. I think it's going to get a little bit more sticky on the good side. Okay, let's go ahead and turn on our Squawk chat here from Financial Juice. Go ahead. So if you hear someone else talking on the stream, it's our good old friends here at Financial Juice. And that's why we have no music here, so we can clearly hear what's going on the Squawk chat. Oh, looks like, and by the way, that poll closes 1 or 2 minutes before the CPI comes out, so make sure you lock in your vote. Currently, it's evenly split: higher, nominal, lower. It's all evenly split. If you guys want to explain why you think what you think in the chat, I'd like to read it. And then post CPI, I do have something a little special for you guys who stick around post CPI. I have this little thing here. Let's see. I believe I have to pull up this is on a weekly chart, so yeah, on a 12-hour. Check that out. Look at all those little dots. Might not make a whole lot of sense, but once I throw on the ranges here, it probably makes a little bit more sense what these timing dots, quote unquote, are going to end up being for. So if you'd like to stick around after CPI to see what I've been working on, as a little preview into something I got cooking in the background, indicator-wise. So that's just for you guys who stick around after CPI. Show you what that could be used for. Got some good ideas on what to use that for.
In 5 minutes' time now, at the bottom of the hour, see the release of the US CPI data for the month of March. CPI year over year, forecast 3.4%, prior 3.2%, range 3.5% to 3.1% expected. CPI month over month, forecast 0.3%, prior 0.4%, with a range of 0.5% to 0.2% expected. Core CPI year over year, forecast 3.7% on the prior 3.8%, with a range of 3.8% to 3.5% expected. Core CPI month over month, forecast 0.3%, prior 0.4%, range 0.4% to 0.2% expected. So taking a look at a preview from Wells Fargo ahead of this release, they note that the March CPI data demand's increased attention after the consumer inflation surprise to the upside at the start of this year. So Wells Fargo note that at a high level, they expect a bumpy and stubbornly slow retreat in inflation, which was on full display in the month of March, they predict. So they forecast headline CPI rose by 0.4% for a second straight month, pushing the year ago rate to 3.5%, which is above the median estimate of 3.4%. So Wells Fargo note that part of that gain will come from higher gasoline prices during the month. And when excluding food and energy, they expect core CPI month over month advanced 0.3%, which is in line with the median estimate.
Yep, that
Wells Fargo
was
note that they anticipate core goods inflation likely fell back into deflation territory for the month of March, while core services inflation was likely little changed, as a further moderation in shelter costs was offset by a pickup in services ex housing.
that's financial juice. Keep getting cut off, but as soon as I hear them, I'm going quiet so then I can listen to the squawk, and you guys can hear it too as we go in, because they'll go ahead and give a bunch of extra commentary very, very, very quickly. That's kind of their whole job. And we have some charts here, so then when they give some commentary, we can immediately pull up a chart and see what it is they're talking about. And that little bit that they were just talking about was actually about Wells Fargo's expectations, which I believe, if I'm not mistaken, they mentioned right here in their US CPI prep, which is this little section right here, right here. Yep, we forecast headline CPI rose by 0.4% for a second straight month, pushing the year ahead rate, and then the core CPI to 0.3. They're focusing on Wells Fargo quite a bit, and I actually posted the outlook from Wells Fargo giving this commentary in the outlook section of the Discord. And FYI, bring up your economic calendars now on your side. The stream is on a 3-second delay. So make sure you bring up your economic calendar so that then you can watch this in real time on your end, because we are now getting US CPI in a minute, which means it's time to close the poll.
1 minute remaining. I'll lead with US CPI year over year.
A bit of a pullback on Bitcoin, the S&P. Gold futures just jumped a bit. Dollar is falling.
Ten seconds. Three spot 5%, 3.5% higher than forecast, 3.4%. Seeing
Hotter
CPI month over
inflation.
month as well. 0.4%, 0.4%. That is as higher than the forecast of 0.3%. Core CPI year over year, that's 3.8%, 3.8% higher than forecast, 3.7%. Core CPI month over month at 0.4%, 0.4%, also higher than forecast, 0.3%. So looking to the markets here, large downside movement in the S&P 500, large strength in the dollar as well. CPI reports hotter than expected across the board. US short-term interest rate futures also dropping after that CPI report.
Holy smokes. Look at the dollar. Look at Bitcoin. Oh my god. All right, that's an alert on dollar CAD on my end. Dollar CAD's going higher now.
So also just taking note of the US CPI indexes here. So CPI index at 312.332, which was a higher than expected 312.073. A core index for CPI at 316.698, and that being higher than the expected 316.558.
Eurodollar just tanked.
Gold declining after the March CPI readings as well.
Gold declining. I don't see gold Oh, this is
S&P
delayed.
extending declines pre-market. That's the futures now down 1%. Dixie up
Oh.
0.4% now as well. We have posted out that March CPI report on the feed for anybody interested.
Yeah, these futures are delayed. My bad. This data is delayed here on the ES. So these charts here are all in real time on Eurodollar. We'll go back to the DXY. So, did I call it or what yesterday?
So looking at the contributors in this CPI report then, so it appears that transportation services was by far the highest year-over-year contributor to CPI in this report. Again, in terms of year-over-year CPI, positive contributors include things like electricity as well. Food away from home continuing to increase as it has done in the prior few reports as well.
All right, so let's go ahead and check out the
US Treasury 2-year yield spiking around 16 basis points following the inflation data.
Oh, that's right. We got to check out the yield spreads real quick. Go to Eurodollar.
So that's the 10-year yield up over 10 basis points now, around 4.47%. 2-year, again, up around 16 basis points. The US 30-year yields, that's up over 10 basis points now on the data as well.
Those yield spreads are so negative. It's almost like people have been shorting into this
June, to start the Fed rate cuts after that inflation data. Now seeing later start as more likely.
All right. June is now officially below the 50% mark on bets. I'm posting some of the text I'm getting from Financial Juice into the YouTube chat. Man, traders bet against June start to Fed rate cuts after inflation report. Now see, oh man, again, I'm getting so many alerts. Okay, so I'm making money.
We're now just seeing Goldman Sachs as they raise China's Q1 year-over-year GDP growth forecast 5% from 4.5% previously. That being due to manufacturing strength.
Check that out. The dollar has moved quite a load here. But yeah, the last couple of streams over the last few weeks, I've been saying, hey, these manufacturing PMIs ain't looking good. So let's see, what are the major contributions to CPI this time around? So this is the table we want to look at. I'll go ahead and paste it here. And just expand it. Oh man, it's almost like my expectations have totally lined up. So these little arrows are timestamped for the 5th of April, which is right over here on the Eurodollar. And today's the 10th of April, so this is 5 calendar days later. And looks like we are hitting our expectations.
In 10 minutes time at 8:45 a.m. Eastern time, expect comments from Fed Governor Bowman, who discusses Basel capital requirements at the European Bank Executive Forum. And no text expected.
No more financial juice required. Let's go ahead and check out what moved here. So energy inflation apparently came down. Oh, this is for all urban consumers. Let's see here. I mean, electricity went higher. All in all, yeah, food away from home went higher. Energy went lower as a category. All items less food and energy, so the core remained flat. That's actually really not good. What contributed to that? Oh, medical care services really jumped high. I don't know if you guys can see that or not, but medical care services jumped 0.5 here in the core section. And people were right on the used cars and trucks and the new vehicles section, seeing some disinflation. People were right on that front. But it didn't make up for all the little extra upticks in all these extra ones, plus the jump in medical care services. So the medical care services totally overwrote the used cars and trucks section of core inflation. Let's see. Anything else we can delve into here? Food, energy. Let's see here. Medicare index rose 0.5% in March after being unchanged in February. Let's see here. Energy. Energy index rose 1.1% in March after increasing 2.3% in February. Yeah, so inflation still rose in energy, but definitely not to the extent, that a lot of people were seeing. So it's mostly been flat in a lot of areas. And for the motor vehicle sector, yeah, we saw disinflation there, but it was overridden by the medical care area, seeing a jump. So if anything, this was the surprise that caught people off guard, is medical care rising on the core front. And that likely contributed to the sticky part in the headline metric here. And then the food away from home section also rose. So those are the two major components, I think. Oh, am I making more money? Yes, apparently I am. I was long dollar going into this, as you can see from my expectations. At least you can see my expectations. So when I say, hey, I think something's going to go up, and I actually draw a line saying, hey, I think something's going to go up, you can actually see where I was expecting things to go up and when. So you'll be able to always see to what degree I'm right, what degree I'm wrong. So yeah, these are very, 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 I mean, look at those yield spreads. The major impact this is going to have on a lot of assets is that this stickier inflation is going to push back the odds of the first Fed cut further out in time. Right, traders from financial juice, traders bet against the June start to Fed rate cuts after inflation report now sees later start more likely. So June is getting written off, and maybe July as well, if manufacturing continues to get stronger at this point. The employment side on the US remains strong, which is good to see. But inflation remains sticky. So when you have that combo, the Fed's probably going to stay hawkish and higher for longer. Okay. With that all said and done, let's go ahead. And I promised you guys I'd give you a little sneak peek at this thing. I just try it out here. So if you're not familiar, this is one of the tools I use to set my expectations. You can actually see like these green spots and these red spots. And then my arrows kind of line up with big chunks of these green and red spots. This is just showing, hey, where are the lows most likely to show up for a given week? Where are the highs most likely to show up for a given week? And this new indicator here with all these dots is to try and help with the timing. So if I hide these things and you see these dots, the more dots you see that are all clustered together, the more lows for a week are around there. So you can see there's very few lows around here, and a lot of lows here are made at the end of the week. A lot of the highs are made here at the end of the week, but also a lot of highs are here right at the start of the week, and a lot of highs are here right at the beginning of the week. And then if we overlay that with our ranges, you can actually see some overlap. So there's a bit of a cluster of highs right around this area here. And maybe we get some positive drift and get a high around here. And then there's like some really, really high highs on particularly strong weeks, like way up here. So I'm going to still be kind of targeting this little chunk right here. There's a lot of high dots right around there as far as timing goes. And maybe we end up just continuing to rise, and we get our high probably right around here, right at the end of the week. So this is telling me, hey, you know, when you're right here, either anticipate another jump sometime here on the 11th of April, which is tomorrow. Either anticipate another jump that takes you like to up here, which would be about 100 pips higher, or expect some kind of pullback or sideways movement into the end of the week. So sideways movement would lead you to get your high around here. Pullback would mean you get your close probably around this spot here. And that's just one example. We can pull up the euro dollar, and it gives you a whole different set of dots. This actually was pretty hilarious when I first saw it. So I'm going to hide this. I'm just going to highlight this spot here. This is the high for the week right now on the euro dollar. And notice how this is right where we have a bump here in our distribution where we see a lot of the highs for a week. And note, when we have these dots on, there's actually a cluster of dots for this particular bar at this particular time right around here. We're only about 6 pips off from this cluster of highs right here on this particular bar. So each one of these dots represents a high for the week. And each one of these little green dots represents a low for a week. And you can actually see right now we're at a cluster of where you see your low for the week if the low for the week were to come in right here on this bar. And then there's like a whole nother set, another cluster of lows around here. I would not be surprised actually to see the low just either come in around here, around this cluster of dots. I'm kind of just looking at the data and doing, you know, a discretionary interpretation of it, saying like, hey, there's a lot of data right here. Check that out. It would be nice to have some thing that would highlight clusters of dots. But right now, because the dots have some opacity to them, when you see a lot of dots on top of each other, they make darker circles. So you can see this is definitely a large concentration where you find a lot of lows. Same thing around here, but these are on the last trading days, the last bar of the week. Also, what's kind of interesting is when you look at this, see how it kind of fans out, right? You got a lot of your lows either right here close to the open, and then it gets a bit further from the open, a bit further from the open, a bit further from the open. There's like a line that goes through this as to where the low usually comes in, and then the same thing for the highs. And then, of course, you have these tails. It gets really big at the edges, at the last few trading days here of a given week. You get big reactions towards the end of the week, it seems. Your biggest reactions can come towards the end of the week. So it's just nice being able to see this data. And when I have this particular indicator to help, wait for it to load. There we go. When I have this particular indicator to help, it's nice to say like, hey, a lot of lows probabilistically coming in this spot. Do we have a large cluster of lows that come in at a particular time? Well, it seems like right around here is where we find that. Otherwise, it seems like the low probably comes in a bit further or towards the end of the week down here. So who knows? Maybe the low is coming in right now, a little further down later on in the day, or somewhere around here. So I kind of have 3 possibilities: right here, or end of week right here. I mean, you can also highlight this, but it's just a matter of, picking your poison based off what exactly your expectations are. So setting expectations are really important. And I find this to be a nice little addition to the tool set. This is kind of the alpha version of these timing dots here, and it's still going to need a lot of work, but some good stuff can definitely come out of that. And if you want access to it, there's a link to it in the description. Just check it out. There's a free 10-day trial for this stuff. Comes with a bunch of other indicators too. Not just the ranges and these dots, but also this thing called seasonal forecasts and these probability pivot points as well. Yeah, probably finding the low right around there. And this is the seasonal forecast. So when your data is behaving seasonally, you can get some seasonal expectations of how your data performs. Now, I don't know about you, but this data does not look like it's behaving seasonally. So I'm not going to be using these seasonal forecasts. That's one of the things that really irked me, or rather, one of the things that very, very much I find problematic with people who do seasonal interpretations is when you are using seasonal indicators or seasonal data to drive your trading expectations, there's the underlying assumption that, hey, is your data behaving seasonally? Do you have seasonal expectations? Because if you don't, you probably shouldn't be using seasonal data. And look at this. So this is the other indicator that comes with the ranges and the dots. Probability pivot points. Hey, this is the probability weighted pivot low for the week. Check that out. 38% of the time, the low for the week over the last 21 years comes in between these two pivot points. Oh yeah, two-tone. The dots are definitely going to be coming. I actually think the best way to incorporate these dots at the moment is actually to build them into the ranges directly. But I may need to rethink that. I just have a limiting factor I got to work around. TradingView will only allow 500 labels, and each one of these dots is a label. And sometimes most of the time, you have more than 500 data points. So I need a way to, either say you have to apply multiple copies of the timing dots to your chart, or I don't know, I have to figure out some technical limitations around this. And it's not very feature rich. You can only change the time frame on it. Again, this is the alpha and kind of the preview of what's to come with it. But all in all, these things are going to be very, very helpful in identifying spots where likely tops and bottoms come in timing wise with the dots, right? Where you see large clusters of dots. And then these help with finding out, hey, where you have the highest probability density of finding a low or a high for a given period, like a week or a month. So lining up the timing with these ranges, I think is I've been wanting to do these timing dots for so long. I actually had the idea for this for some seasonal indicators like almost close to 2 years ago, but man, it's just there's a lot of limitations that go behind these getting these timing dots to work correctly. And there's been some improvements in PineScript that have made it much easier to get these things to work. So, thank you TradingView and PineScript for all your development needs. Let's see, exactly what I was thinking. I think it would look good for you to visualize it exactly as the range probabilities are visualized, but seeing that y-axis would be very important. Yeah, man. I don't know how long it'll take me to get the first release of this thing out, but all things considered, just a little bit of code cleanup and actually allow you to like do stuff like change the colors here and the sizes of the labels and the whatnot. And also remove some debugging tooltips that I've set here. Yeah, just a little bit of cleanup from this alpha version, and this thing should be good to go fairly quickly. But as far as actually using it, it seems like we see the low here on euro dollar on this bar very frequently. So sometime on this bar we could see the low for the week, and if the low for the week is not here, there's this section right here that I'm eyeing. And you can see like, hey, these are some clusters of dots that you see more overlap with. It's either this little section or that little section. I don't know if looking at this whole section here at the end of the week makes much sense. That would imply like you have a drop at the end of the week here. Maybe there's some economic events to watch out for, but even then, it's like that cluster looks pretty freaking strong. You got a lot of lows for your week. Like these are the lowest points for your week. You get a lot of lows right around here towards the end of the week. Yeah, and look how the thing tails off here. So yeah, I'd expect sometime in the next 24 hours, maybe we fall another 75 to 50 pips. And if we don't, there's either one of two options. Either the thing bottoms out somewhere around here right now for the week, or we end up bottoming out around these prices 50, 75 pips lower on euro dollar here towards the end of the week. Let's check out the S&P on the dots as well. Yeah, this actually looks a bit more bearish. I'm kind of eyeing this kind of cluster right here. And a lot of lows on this particular bar here. If you go past, what is it? Call it 5120. So past 5120 on this bar here. So in the next 24 hours, past 5120, I'd be, concerned about hitting the high 5,000s around this area here. But then that'd probably bounce. So either the thing drifts lower into a low and a close at the end of the week, or maybe sometime here in the next 24 hours, we find the low for the week and the thing either just drifts sideways or bounces a bit higher into the close. Oh, wow, check that out. There's a cluster right here. So this is the high for the week on the S&P, and we have 3 little dots right there. Right there where we have the high for the week. Again, you're more likely to get your high for the week up here, but that's probably on good CPI, right? Yeah, dude. Have dot meta. Yeah, man. No, having these dots are going to be very, very insightful for just discretionarily figuring out, like, okay, when do the tops and the bottoms come in? And the ranges are good at asking the question, where do the tops and the bottoms usually come in? So when and where? A very, very nice development from Boss Benchmarks. Alrighty. So I'd say we're probably going to see some continuation risk off moves lower as we get into the next 24 hours here, and then either some sideways drift into the end of the week or a bounce higher. Let me head over to euro dollar actually and just draw my expectations real quick. So what I was saying, probably finding your low around here. Yeah, around this area here. So let's kind of split it down the middle. Call that red. And then probably a bounce higher into the close or sideways, right? So let's just do like a little thing up like that. And timestamp that. So probably something like this. We'll definitely be closing below 108 this week, I think, on the euro dollar side of things. And we'll see in the future daily plan streams how this little micro expectation going into the end of the week holds up. I mean, the nice part about these indicators is they work on every chart, so we can go to Bitcoin, see how that's held up. It's held up actually pretty darn well, I'd say. Wow, there's a kind of obvious cluster of lows, like right around here over the next 48 hours. So I'd be concerned of a move like that. And we'll follow up on that expectation in the streams going here into the end of the week. But at that point, I don't know, the thing would probably bounce. So it looks like the theme I'm drawing here is for some move lower over the next 24, 48 hours, depending on the asset, and then a bounce into the end of the week for a net red week. Man, yeah. Let me know what you guys think of the timing dots and the ranges. And again, if you want to try them out, the link to that's in the description from the WAP store, 10-day free trial and all that. And the Discord group is free, where I share a lot of what I do. Like all these Twitter posts. Like this one here that went over all the expectations. So let's see here. We got this move here on the S&P. So let's actually go to ES. And looks like we got exactly that, right? We got, I think somewhere, no, we got, what exactly was the CPI reading that we got? We got 0.4 month over month. But what was the second decimal spot? They don't share it. They just say 0.4. So when we check this out, it's this column right here, or this row right here at the very bottom. And Goldman Sachs is expecting negative 2% on the oh, so that's if it's core. So let's see here. Core. Oh yeah, so that still lines up with this column here. So it doesn't seem like we're quite done with this move. Yeah. Not great expectations here over the next 24-ish hours. I'd probably would be looking at this cluster here for the lows, or right around here on the very last trading day of the week for a likely low. It looks a bit more uncertain in my view. Like this area right here, or just sometime on the last day the low comes in. Which means no buying the dip into the close scenario. Alrighty, you guys. I believe that's everything I wanted to cover. And again, thank you guys who stuck after CPI to kind of check out the alpha of that little prototype for the timing dots. I think they were pretty useful for this stream. I'll keep working on those, try and get them out for you as quickly as I can. And I hope you enjoyed at least the preliminary research in the first half hour for CPI. And like I said, you can get all the links to all these resources, including this one here on Canada, because following up on the Canadian dollar here is going to be pivotal. It looks like the Canadian dollar will probably be weakening. So if you are looking at some FX research, Bob Elliott's a pretty good guy to follow. And if you want the link to this, the Discord's free. It's going to be in the economics research channel. That's where you can find the link to this. Alrighty, guys. With that all said, I will see you all in a bit.